there's not really going to be any cash flows during the period of time. Most syndications don't really have cash flows anyway. So it's like, why does it even matter? But you let them know, hey, look, I only really get paid when I do what I'm telling you is possible. You don't have to believe me and see the numbers that it's going to hit this metric, but you're going to have the security to know that, look, you're going to get your prep, you're going to get your principal back one way or another. And the only way I'm really going to get paid is on the backside when I increase the valuation up.
Welcome to the How to Scale Commercial Real Estate Show. Whether you are an active or passive investor, we'll teach you how to scale your real estate investing business into something big.
Ace Karimi buys cash flowing apartment buildings through a unique syndication model, and he teaches others how to do the same. In 2021, he bought $35 million in deals, and they are growing. Ace, welcome to the show.
Welcome, Sam. Thank you for having me.
Hey, man, pleasure's mine. There's 3 questions I ask every guest who comes on the show. In 90 seconds or less, can you tell me, where did you start, where are you now, and how did you get there?
Wow, I like it. Rapid fire. So when did I start, or did you say where
did you start, where are you now, and how did you get there?
We started, I think, 3 years ago. We jumped in from single family. We used to do a lot of wholesaling and flipping. So pretty sure you're familiar with that. You're on a hamster wheel, always hunting the next deal, looking for those single checks. I realized we wanted a better way. We wanted consistency. We wanted predictability. So we made the jump. We made the leap one day. It was actually right before COVID happened, believe it or not, where we went really, full, all hands on deck. Like, hey, we're not turning around. This is it. And that was the year that we ended up buying $35 million in apartment buildings through our unique syndication model, in which we're able to give the investors their money back a lot sooner, 24 to 36 months usually, and give them an infinite return while still keeping most of the deal.
Now, that is really cool. So you guys went long in multifamily at the beginning of the pandemic. How long did it take you to get your first deal?
Let me think. So here's it's the funny thing is, you know how you start doing it initially, you're kind of just looking at deals on the side here and there. If I look at it from that regards, probably like, I don't know, 3-4 months, something like that. But when we really went like committed, hey, this is it, we're going to find a way, it was like maybe 60 days.
Okay. Yeah. That's pretty fast for people, out there listening. A lot of people we talk to on the show just say, hey, look, be patient when you get your first, be patient, because it takes time to get your first deal. What do you feel like you did differently that allowed you to find your first deal so fast?
Massive action.
What does that mean? Can you define that for us?
Dude, just getting your name out every single place possible. I mean, that's the thing. It's like, you got to let everybody know you're buying, unapologetically. I was letting it be known, like, hey, I'm going to buy apartment buildings. And everybody that I was talking to I was following up with them consistently. And I'm like, hey, look, do you have something for me? Do you have something for me? I'm looking, I have capital sitting right here. And I eventually found one.
Okay. Tell me about the first deal. How big was it? What were the parameters of it? And how did you know that was the one for you?
Oh, man. So, yeah, great question. So, your first deal, it means so much, because once you can really identify what a deal is, it makes everything a lot easier for your second, third, fourth. The domino kind of trickles down. My first deal, we were at our first deal 4 different times. I had one down in Georgia. I had one down over in Maryland. Like, I'm in the East Coast, by the way, right? I'm in DC. So I'm over here looking out of the area, which, you're as more of an inexperienced investor getting into multifamily, you're just looking anywhere and everywhere for a deal, which is a big mistake, right? And so it was so many close times where the numbers look good, everything looked good, but something just didn't line up and we had to pass on it, which, you have to have the discipline to do. And we ended up finding this deal that literally passed and checked every box that those other properties didn't, right? It was a 72-unit property in my home state here in Virginia. So I'm right out of the DC metro. I'm in Northern Virginia, and great property, beautiful, right? Still, it was like a 70s build, but it didn't look like it, right? It just, the owner was already starting to put a lot of CapEx into the property as we were looking to buy it, which was great. Already started doing the windows, the roof, and the plumbing work and a lot of the exterior stuff. So, he was already getting that ball rolling for us. And, we came across the deal, and it had a beautiful view of the mountains, believe it or not, which was amazing. That's just one of the things that's like, it felt good. I think that's one of the things that you just know if it's a deal, something feels good about it. It's in a great location. You're just like, dude, I would love to own this asset.
Right.
And then the numbers, like the numbers look kind of slim at first. Like we bought it for 3.8 million. It was a 72 unit asset, right? Market rents were nuts. They were at $600. And at the time, yeah, exactly. And at the time, the rents in the market were like 900. So there was a $300 discrepancy. And now, fast forward to now, they went up to like 1,100, by the way. So we've got a big boost. We came across a deal. We had a discussion. We went back and forth, and then we ended up putting it under contract at 3.8 million. Put $600,000 into the property. We knew we could drastically increase the value. So we underwrote the valuation around 6.5 million, I believe, conservatively. So there was a couple million in equity at play. And from our modeling, we realized that, hey, look, we don't necessarily need to give up most of the meat of this bone. It's a heavier value add property. We have a lot of work to do, really have to, roll up our sleeves. And so we used our own syndication model in that regard, and we gave up a higher preferred return. And we actually kept most of the equity for ourselves because of the work that was involved. And we promised an 18 to 24 month principal return, which we're actually on pace to do that even faster right now. We've already initiated a refinance. And essentially that's it. And they get to stay in a deal in perpetuity, and they get 100% of their capital back and a check, and they get to keep the pref, and they get to stay in a deal. And on top of that, they get a check at exit. So it's pretty awesome. And our valuation, by the way, for this deal is coming between 9 and 10 million.
I was going to say at a 10 cap, you're based on the rent bumps. I'm sitting here running your numbers behind, and I'm like, okay, it's worth about $9.5 million at a 10 cap.
Yep.
I mean, so that's ridiculously probably low, I would think, the actual valuation. So that's really, really cool. Tell me, I want to hear more about the actual structure of how you brought investors in on this deal. Because what I heard was that, did you identify and line out those terms? Obviously on the front end, you said, okay, hey, here's exactly how we're going to take this down because we just see huge runway here. And then I guess break that down for me. Let's assume I'm an investor and I say, hey, Ace, I want to put $100,000 in your deal. How does it work?
Oh, great question. So essentially, yeah. So, hey, look, we if it's this type of a deal, right, it has to be a specific type of deal. But, I'd go into the conversation, be like, hey, look, I have a great opportunity. There's a lot of upside, several $100s of upside. We have several comparables to prove that. It's not just one or two. This isn't speculation. Like, this property has not been bumped up in a while. The owners kind of had some deferred maintenance to it. There's a lot of work involved to go in there and to raise these up to market level, turn all the tenant base. And we're prepared to do that. But in order to do that, and to make this property worthwhile for everybody, we ran the numbers. We're buying it at an incredible price, far below market value. And so here's where it's going to be valued at in 18 to 24 months. We're actually going to be able to give you your full principal payment back. And we're giving you a higher preferred return. Here's a structure. And then I showed them, hey, look, you're going to be able to make, 30%, 20, 30, 40% in that short amount of time. And you get your 100% of your principal back. Because at the end of the day, what they care about most, number one thing, isn't how much money they're going to make. And this too, Sam. They care how long is it going to take to get their money back.
Right. If
I can tell them, hey, look, I'm telling you right now from what I'm seeing here, 24 to 36 months, you get all your money back. You get an 8 to 10% pref. Actually guaranteed. You can't ever guarantee anything, but it's like, dude, you're getting the pref. All the money is essentially going to them. I'm working for you, essentially.
Right.
I'm not getting paid. I'm getting paid maybe some fees, but the alignment with it is because there's not really going to be any cash flows during the period of time. Most syndications don't really have cash flows anyway. So it's like, why does it even matter? But you let them know, hey, look, I only really get paid when I do what I'm telling you is possible. You don't have to believe me and see the numbers that it's going to hit this metric, but you're going to have the security to know that, look, you're going to get your prep, you're going to get your principal back one way or another. And the only way I'm really going to get paid is on the backside when I increase the valuation up and you've already got your money back in your pocket safely.
what is the investor split once you give them their money back? So you've done a cash out refi, you've given them a 10 pref on the deal, cash out refi, I got my money back. What's your investor split going forward?
30%.
Okay. So it's still a 70-30 split. But
yeah, and they get to stay in a deal. Exactly.
It's flip-flopped in this case. Most of the time, it is 70% to the investor, 30% to the sponsor. In this case, you're saying, look, if I can get your money back in 24 months, give you a 10 pref. Of course, the pref goes away once the capital is returned. At that point, you collect 30% of the upside on the cash flow, and then upon disposition, and you as the sponsor collect 70%. Do you guys, and again, I'm sorry I'm getting in the weeds on this, but this is very different than what we see, a pretty standard syndication model. So this is why I kind of want to spend some time on this, just to hear that, give listeners the idea that there's other options out there for how we structure these deals. So you return the 30% to your investors, but do you guys take acquisition fees? Do you guys take other fees on the front end of these deals, or do you waive all that just so you can say, hey, you know what, we are truly getting paid only when we perform?
No, I still take the fees because you know what, the reality is, like, the kind of deals that I'm talking about here, by the way, they're not something that you just find. Like, we have to hunt for these deals usually, right? So if I'm hunting for these deals and I'm spending time, resources, money, months of follow-up, like, this is something that, yes, we will still take a fee on up front, and it's not like it's going to go straight into all my pockets. It's just to reimburse really for our soft costs. Sure. That's not even money that we're really grabbing. And then on a second hand, the asset management fee is just there to just take care of the asset management team in the meantime. But it's really pennies. Like, this isn't like you're not really doing this on a large scale. That's the differentiation I want to make here. You're not doing this on like an $80 to $100 million property. I think you could if you find it properly. But this model is great for somebody who's just starting out, who sees an opportunity with an asset that's got heavy deferred maintenance and needs a lot of work. And you're like, dude, I can come up there, scoop up a lot of the equity, do a lot of hard work once to twice, grab that equity, give my investors a return, and then go put it into something better. Does that make sense?
It does. So I guess that's a follow-on question to your investors. A heavy lift, heavy value add, maybe low occupancy, maybe there's crime, maybe there's a lot of those things that go along with it, feels like additional risk, to a lot of investors. How do you frame that conversation to let them know, hey, we can make this work, and it's not as risky as it may seem?
Oh, for sure. Here's why our model still has certain metrics. It still has to be a B area, like C+ at the worst. I'm not going into the hood. Like, I'm just not. There's no way I'm going to go in there. Some people want to do that. I'm not. Like, these properties still exist where they're in good areas. They're just mismanaged. They're just not. They're not looked after properly, and the right operator can go in there and turn things around. And so at the end of the day, like, if it's 40% occupied or something, I wouldn't really look at it too much. Like, I'm not taking on that much extra risk where I'm saying, hey, look, I'm going to go into a D-class area and take on a property that's low occupied. No, that's just trouble. We stay away from that completely. So there's complete no's that we do. Sure. Our properties, I did 3 of these in 1 year. They were all over 90% occupied. Wow. And they were in good areas.
90% occupied. Yeah. Sub-market rents because the place looked like garbage.
Yeah, they just didn't treat it right, dude. And here's the thing. It's like, and I tell people this when they ask me, it's like, the owners they don't care. Like, they're not looking after the property. They just, hey, I'll just take a check and whatever happens. And property management's usually not involved. And, that's just what's going on. Nobody really cares. Like, we care about our properties. Right. My team's involved every single week. We're on Slack. Well, we have a communication channel 24/7. We do weekly pulse checks. We're looking after our asset for our investors, but also for ourselves. That's always how I am with any business I do. I'm keeping my eyes on the prize.
Right. No, I think that's really, and we bought one like that last year. It's just like, absentee owner, run into the ground. They didn't care. So I get it. Then again, they were making their money along the way because they bought it, 8 years ago for a song.
Exactly, dude. They're happy either way.
They're happy. They're clipping a coupon and the place looks terrible.
To be honest, you want to be them. Like, that's what I tell people. I'm like, dude, it's not the fact that I'm winning. These guys already won. they're like 8 to 10xing their money doing absolutely nothing.
Well, for sure. They're also slumlords, and those are the people that we want to get out of the business. So it's
That's true.
I mean, they're the ones that give us a bad name. And you're the one going in there and giving us a good name. So you're doing right. And I like that. Tell me about, how do you offset refi risk, especially in today's rates environment? I mean, your business plan sounds incumbent upon being able to refi this property in 2 to 3 years.
No, I could also just sell it too. Like that's always something we let them know. Like, hey, look, because if you sell it, they actually get a higher than average returns metrics. It's usually like 3x, 2.5, 3x or something. So if we sell it, they're even happier. They're like, wow, I'm making all my money. Right. But to be honest, they want that capital to be used all the time. So we always run in both scenarios. We present both in front of them. Here's our plan A is to go and refi. But if we can't do that, if we sell, here's what it looks like. And on one of our deals, it was flip-flopped. We're saying, hey, look, we're looking to sell this deal, but if we can get an above average valuation, higher than our conservative number, then we're going to refi. So we always run both scenarios because it's like, I don't ever like having one exit and being forced into a position. Not the way you want to do that, especially with these big deals. That's usually it.
Right. No, that makes sense. That makes sense. You could always sell it. What is, I guess, when you guys look at a cash out refi, are you maximizing the amount of capital you can pull out of the deal, or are you deleveraging in some capacity, or what's that? How do you like to look at that? I'm sure it's on a deal by deal basis, but what's your general feeling around that?
No. The funny thing is, so this first deal that we just refinanced, right? Like, we're only going to pull out 70%. Mm-hmm. You don't need to pull all of it out. I think, it definitely keeps some in the deal, or just cash flows to always pay things off. You always got to be looking out for the worst case scenarios, man. I'm just like thinking in the back of my mind sometimes. I'm like, okay, some crazy thing happens. I don't know. Like, you got to have months where you're able to have reserves. Something drops, something crazy happens. Like, you got to make sure you can always break even. You have extra months to pay things off. You do all this work, like, what's the point? You pull out 80% and then your margins are thin as it is, and you always need to keep it 98 to 99% occupied. It's not smart.
Right. Nope. I hear you, man. That makes a lot of sense. Ace, one of the things we talked about before actually hitting record on this was that you feel like finding investors is really easy to do. That runs kind of counter to what a lot of people experience, especially getting started. Why do you say that?
One, it's perspective, man. I really think it's like just a perspective. Like, I've always had that belief, even before I raised any money. When I was wholesaling and flipping, I think that's one of the things that I saw. It's investors are hungry for deals, man. There's so much like hunger and desire for just an opportunity, right? They will jump on it. I've seen when I used to wholesale houses, because a lot of times we flipped, but sometimes when we wholesaled, if I send it out in an email link, okay, and I had a property with some margin, with some meat on the bone, and they can make, 15, 20%, dude, you should see how often it would blow up my phone. Hey, what is it going to take to get this deal? What's it going to take? You let me know. Give me the number. Hey, man, I don't want to be in a bidding war, blah, blah, blah. And I'm like, dude, here's my process. If you want to get the deal, I need you to come in highest and best and stop playing around, because I have the opportunity. I want to build a relationship with you, but you're not going to come in there and undercut me. So it's a respect thing, right? You have to come from a place of respect, of holding yourself in a way where he's like, dude, like, I gotta understand that this guy has the value and I'm trying to build a relationship with them. I always look to the future. Sometimes I'll even take a little bit less, but I always go with the guy that I felt better about, that I knew had more principles, instead of going for the extra $5,000, $6,000 on somebody I did not like. I didn't like the way they were carrying themselves, and they acted like they could run me just because they had extra money. It's like, it's always about principles to me. So when I saw that in wholesaling, that people wanted opportunity, and everywhere, hundreds and hundreds, and like that I had just in my local market, who just wanted single family houses, but when I started talking to them, they were also just down for any opportunity. That's the thing, is if you have an opportunity to make money finds deals. Money's trying to find deals to go into. And the only thing is, you need to have good enough deals that the money wants to be a part of. Right. That's how it works. So, like, now that I did my apartment building, I probably raised, I don't know, $5-10 million by now, and really over in about a year. the thing is, it's like, as long as you structure it clearly, they see the upside, they understand. To me, everyone is an investor and everyone should be an investor, right? Like I have my shirt here, right? Like part of our mission in our business is to help everyone become investors. I've invested my own family's money in on my properties. I believe in it that much, right? Savings accounts for years. I have friends of family that are investing with me. They're investors. Everyone's got money stacked away. They just want to be like, that guy's an expert. I trust him. He's an authority. He knows what he's doing. And I feel good. And you set the right expectations and you just lay back. You should see the responses. Some of them, they just do it because they trust you. And then throughout the actual stabilization period, dude, they're collecting monthly checks and they're happy. They're not getting that from stocks. Where else are they getting that? So just from the monthly drip alone on 6, 7, 8% pref, dude, they're happy. I promise you. And then they don't even realize that, like, when I return their money and then I'm going to give them an extra check at refi, dude, their mind's going to be blown. Right. But just the pref alone, like, that's powerful. It is.
It really is. It really is. And that's, I got one of those texts from somebody the other day that just said, hey, thank you. Thank you for giving me an opportunity to get out of the stock market and get paid on a quarter. We do quarterly distributions, but get paid quarterly. This is awesome. Yeah. I really appreciate it. It's like, oh, right. What you're doing is of value. Ace, thanks for taking the time to come on the show today and share with us what you've been doing, how you've done it so quickly, your perspective on, how, finding investors is easy to do, how to take on a heavier lift project and yet still offset risk, and, really your unique syndication model. I think that's really cool, the way that you've kind of turned this on its head, and yet at the same time are really attracting investors to your deals in a unique way. So, and congrats on that one deal that you've taken from basically $4.5 million to a $10 million deal in a very short period of time. That is super cool. If our listeners want to get in touch with you or learn more about you, what is the best way to do that?
Social media is usually the best. Add me on Facebook, Ace Karimi, LinkedIn, Ace Karimi, and then on Instagram, at ace.invest. And that's it. I'm happy to provide the rest of the details to you. My email, if they have anything they want to talk about, for sure.
Certainly. And we'll put all that in the show notes. Ace, thanks for coming on the show today. Certainly appreciate it.
Sam, thank you.